The US-China trade war. What investors need to know now. The global economy just took a seismic hit. One decision from Washington sent markets reeling. The S&P 500 dropped to its lowest level in a year. Tensions between the United States and China have escalated into a full-blown trade war. If you're a financial analyst or a serious investor, now is the time to reassess your strategy. In this video, we're breaking down what's really happening, how it's impacting equities, bonds, currencies and commodities, and most importantly, how to position your portfolio for what comes next. Let's start with the big picture. On April 12, 2025, the United States announced a 104% tariff on all Chinese imports. In immediate retaliation, China imposed an 84% tariff on critical US exports, such as soybeans and natural gas. But this conflict didn't start overnight. Tensions date back to the early 2010s, as the US trade deficit with China widened dramatically, reaching $400 billion by 2024. Under the Trump administration, tariffs on $250 billion worth of Chinese goods were already in place by 2018. Several temporary truces followed, but none resolved the underlying conflict. Now the current administration is doubling down. The strategy is clear: reduce reliance on Chinese imports, protect American industries, and contain China's growing technological influence. Meanwhile, China is pushing back aggressively. It devalued its currency by 2%, boosting exports by roughly 1.5%, but also increasing import costs for US companies by as much as 2%. Beijing also cut interest rates to stimulate domestic consumption, showing it's willing to absorb short-term pain for long-term strategic positioning. Unsurprisingly, equity markets were the first to react. The S&P 500 plummeted to 4,082.77 points on April 8th. Tech stocks were hit particularly hard. Apple dropped 10%, driven by tighter margins, down 2 to 3% according to Morgan Stanley. Retailers like Tractor Supply lost nearly 6% under the pressure of rising input costs and supply chain bottlenecks. But not all sectors were losers. In fact, defense stocks surged, with Lockheed Martin gaining 3% as geopolitical tensions stoked defense budgets. Healthcare also performed well. United Health Group rose by over 5%. Infrastructure names like Caterpillar benefited from renewed US spending programs, though they faced a hit to profitability due to rising steel costs. From a technical standpoint, the S&P is now hovering near its key support level at 4,900, with resistance looming at 5,200. As equities waver, capital has rotated into bonds. The 10-year Treasury yield climbed to 4.425% as of April 9th, signaling renewed demand for safe haven assets. Long-duration bond ETFs like TLT have surged 12% since the start of the year. But there are risks. The US national debt has now surpassed $35 trillion, and a further rise in yields to 4.5% could drive significant valuation compressions, particularly in tech, where some estimates suggest a 5 to 7% decline could follow. Retail sectors would also face higher borrowing costs, likely trimming profit margins and dampening consumer credit demand. Gold continues to shine amid uncertainty, with spot prices stabilizing at $3,000 per ounce. The GLD ETF is up 12% year-to-date, bolstered by increased central bank demand, especially from China, according to CNBC. However, it's not without volatility. A recent 1.2% dip on April 7th serves as a reminder. Even defensive assets are subject to corrections in turbulent environments. Still, as a long-term hedge against inflation and geopolitical risk, gold remains a core component of a well-diversified strategy. The currency market is also reacting sharply. The US dollar index fell by 0.9%, although Goldman Sachs has cautioned that this trend could reverse as global capital seeks the relative safety of US assets. On the other side, the yuan's 2% devaluation has helped boost Chinese exports, but it's also increased the cost of imports for American companies. Firms like Coca-Cola are already seeing import costs rise by 1 to 2%, a hidden tax that could impact earnings over time. Now let's talk about tech, and specifically artificial intelligence. There's growing concern that we may be witnessing the early signs of an AI bubble. NVDA is under scrutiny, with its price-to-earnings ratio hovering near 40. That's historically high and suggests overvaluation. Demand for high-performance computing has slowed by 5%, and capital investment by hyperscalers has been reduced by 10%, according to Morgan Stanley. UBS recommends reducing exposure to the tech sector by as much as 20%. One alternative is TSMC, which benefits from geopolitical alignment and remains less exposed to US-China trade risks. Commodity markets are reflecting the chaos. Brent crude now trades at around 60.69 a barrel, while West Texas Intermediate is at 57.22. Goldman Sachs projects oil to stabilize at $62 by year-end. Agricultural commodities are even more volatile. Soybean prices are under pressure due to Chinese tariffs, while wheat has risen by 2% due to ongoing conflict in Ukraine. Agricultural ETFs like DBA are seeing renewed interest. Meanwhile, steel prices have jumped between 5 and 7%, directly impacting industrials like Caterpillar. China is playing the long game. The Hang Seng Index has dropped over 13% this year. In response, China's sovereign wealth fund has injected liquidity to stabilize key sectors, boosting select indexes by 2 to 3%, according to local sources. These moves suggest China is bracing for a protracted standoff rather than seeking immediate reconciliation. Political pressure is mounting. Former President Trump hinted at the potential for renewed negotiations, while congressional leaders push for a reduction in tariff intensity. Internationally, the European Union is considering a 5 to 10% tariff on Chinese electric vehicles. In the background, the war in Ukraine has pushed European gas prices up by 7.5%, adding yet another inflationary layer to the global economy. 3 scenarios are now in play. If an agreement is reached by mid-year, the S&P 500 could rebound to 5,200, with inflation contained at around 6.2%. If escalation continues, markets may stagnate near 4,900, with declining earnings across sectors. But if talks break down completely, we may see the index fall to 4,800, inflation reaching 7%, and consumer demand shrinking notably, particularly in discretionary retail and real estate. So how should investors position now? In the short term, defensive sectors are the place to be. Avoid heavy exposure to tech and discretionary retail. Instead, focus on healthcare, defense, and infrastructure. Stocks like Lockheed Martin and United Health have already proven their resilience. Bonds remain attractive, but monitor yields carefully. Long-term portfolios should incorporate gold, real estate, agriculture, and 10 to 20% cash for flexibility. Risk management is non-negotiable right now. Use protective PIAT options on broad indices like SPY and prepare for a long period of macroeconomic uncertainty. The trade war isn't just a political event. It's a structural shift that is redefining global capital markets. If you're serious about protecting and growing your capital, now is the time to act decisively. If you found this analysis useful, please like the video, subscribe for more in-depth market intelligence, and share your investment strategy in the comments. How are you positioning your portfolio in the face of this global reset? Stay informed, stay protected, and invest wisely.